Hello everyone, and welcome back to the channel. Today, we're tackling one of the most non-negotiable, fundamental skills in a trader's toolkit: capital protection. This isn't about finding a magic bullet indicator or a secret entry strategy. This is about building a fortress around your trading account so that you can survive long enough to let your edge play out. We're calling this the ultimate guide to capital protection for traders, and by the end of this video, you'll have a concrete, actionable plan to protect your capital like a pro. Let's start with a brutal truth that many learn too late. Trading is a business of probabilities, not certainties. Even the best traders in the world have losing trades. What separates them is that their losses are small, controlled, and never threaten their ability to trade tomorrow. The core of capital protection isn't avoiding losses. It's managing them so effectively that your winners can easily overcome them. Why capital protection is your number one priority? I want you to think about your trading account not as a stack of cash, but as the lifeblood of your business. If it runs dry, you're out of the game. This is why we need to talk about the mathematics of loss. It's one of the most overlooked concepts for new traders. The relationship between a loss and the gain required to recover from it is not symmetrical. If you lose 50% of your capital, you don't need a 50% gain to get back to even. You need a 100% gain. The table below shows how this escalates dramatically. If you lose 10% of your capital, you need to make an 11% profit to recover. A 25% loss requires a 33% gain to break even. Losing half your capital, or 50%, means you must double it, a 100% profit, to return to the starting point. A 75% loss demands a 300% recovery, and if you lose 90%, you would need an extraordinary 900% gain just to get back to where you began. As you can see, allowing a catastrophic loss is a hole that is almost impossible to climb out of. This single principle is why capital protection must be your primary focus from day one. The three pillars of capital protection: a professional approach rests on three core pillars: limiting risk per trade, using intelligent stop losses, and mastering your position size. Let's break each one down. First, the golden rule. Never risk more than 1% of your total account equity on a single trade. This is known as the 1% rule, and it's the bedrock of professional risk management. For a $10,000 account, that means your maximum loss on any trade is $100. The power of this rule is that it makes a catastrophic string of losses a statistical near impossibility. You could have 10 losing trades in a row and still be down only 10% of your capital, perfectly positioned to recover when your strategy starts working again. The second pillar is the risk-to-reward ratio. This is where we ensure that the potential profit of a trade is worth the risk we're taking. A common mistake is aiming for a 1-to-1 ratio, where you risk $100 to make $100. This puts immense pressure on your win rate, requiring you to be right more than half the time just to break even. Instead, professional standards start at 1-to-2 or even 1-to-3. This means if you're risking $100, your profit target is $200 or $300. The beauty of this approach is in the math. With a 1-to-3 risk-to-reward ratio, you can be wrong 75% of the time and still not lose money over the long run. It fundamentally changes the game in your favor. The third pillar, which brings the first two together, is precision position sizing. This is the mechanical process of calculating exactly how many shares or lots to trade so that if your stop loss is hit, you lose exactly 1% of your account, no more, no less. The formula is straightforward. Position size equals max risk per trade in dollars, trade risk in price units. For example, with a $10,000 account, max risk $100, and a stop loss set 50 pips away from entry on Euro, USD, where a pip is worth $10 per lot, your position size would be $100 per 50 pips *$10, equals 0.2 lots. Doing this calculation manually before every trade is what enforces your discipline. Practical implementation. From theory to your trading platform now, let's talk about how to put this into practice without driving yourself crazy. Discipline is hard, which is why the smartest traders use technology to enforce it. For MetaTrader 4 and 5 users, there are powerful tools designed specifically for this. You can find expert advisors, EAs, and scripts, like the prop firm Capital Protection Expert, that automate these critical rules. These tools can be configured to automatically calculate your position size based on your predefined risk percentage and stop-loss distance. They can enforce daily loss limits, cap the number of trades you can take, and even suspend trading during high-impact news events, all of which protect you from your own emotions. Think of them as an automated risk manager sitting on your shoulder. Then it comes to placing your stop-loss. One of the most professional methods is to use market volatility. Instead of a fixed, arbitrary number of pips, use the average true range, ATR, indicator. A volatility-based stop, set at something like your entry price minus 2 times the ATR, adapts to current market conditions. It places your stop beyond the normal market noise, preventing you from being whipsawed out of a good trade, while still protecting you from a genuine reversal. Your actionable implementation plan. So, where do you start? I recommend a structured, 3-phase approach over your first year. In months 1-3, your sole focus is building an unbreakable foundation. This means religiously applying the 1% rule to every single trade, no exceptions. Use a position size calculator, whether a simple spreadsheet or a MT4, MT5 script, for every order. Your goal in this phase is not profitability, it is perfect consistency in your risk management. Keep a detailed journal of every trade, specifically noting your risk percentage and whether you stuck to your plan. In months 4-6, begin optimizing your framework. Start analyzing your trades to ensure you're consistently achieving a risk-to-reward ratio of at least 1-2. This is also the time to introduce correlation management. If you're taking multiple trades, understand that pairs like EUR, USD and GBP, USD often move together. This means you're not diversified and are effectively risking much more than you think. Adjust your position sizes down across correlated pairs to keep your total exposure in check. From month 7 onwards, you move into the mastery and automation phase. Implement and test trailing stop strategies, like an ATR-based trail, to lock in profits on winning trades. Work on fully integrating automated tools into your workflow. The goal is to have a system that runs with minimal emotional interference, allowing you to focus on strategy refinement rather than manual calculations. The critical limitations and risks you must understand now, for the reality check. No risk management system is a perfect shield, and understanding its failure points is what separates a sophisticated trader from a novice. First, liquidity and slippage. In fast markets or around major news events, the price can gap right through your stop-loss order. Your trade will be closed at the next available price, which could be significantly worse than your planned exit, turning a 1% risk into a 2% or 3% loss. This is why many professional systems include a news filter that avoids trading during high volatility event windows. Second, model risk and overfitting. You can backtest a risk management strategy on historical data until it looks perfect, but that doesn't guarantee future performance. Markets change, volatility regimes shift. A stop-loss distance that worked for the past 6 months might start failing miserably. The mitigation is to use robust, adaptive methods like the ATR-based stops we discussed and to regularly walk-forward test your parameters on out-of-sample data. Third, the human element. This is the biggest risk of all. You are the one who can override the EA, ignore the stop-loss, or decide to double down after a loss. Just this once. This is why your trading plan must be written down and treated as law. The psychological discipline to follow your own rules, especially after a loss, is the ultimate form of capital protection. To bring it all home, remember this: capital protection is not a set of restrictive rules. It is the framework that gives you the freedom to trade with confidence. It ensures that a bad trade, or even a bad week, is nothing more than a minor setback, not a career-ending disaster. Protect your capital first, and the profits will follow. If you found this ultimate guide helpful, give it a thumbs up and subscribe for more deep dives into professional trading techniques. Let me know in the comments what your biggest challenge with risk management has been. Thanks for watching, and until next time, trade safe.